Capital gains are a beautiful thing. Anytime I put money in and it grows and I can get more money out than what I put in, life is good. But then comes Uncle Sam and the IRS and says, hey, you've got to pay part back. And they really do care about things that I held for a long period of time versus things that I held for a short-term period of time, i.e. the difference between long-term capital gains and short-term capital gains. We're going to talk about what those two terms mean as well as cost basis today on Consider This Program. Well, good morning and welcome back to Consider This Program. I'm your host, Joe Clark.
And I'm Aaron Rheaume.
So happy to have you along. Hey, we are talking about when taxes and investing meet. Part 2. We did this with a CPA, Brett Spangler, part of the FEG team back in May, where we talked about how tax reporting, that means that's the story you tell the IRS. It's what goes on your return. Today, Aaron and I are focused on tax planning, things you need to do, things you're going to want to consider before we get to the end of the year, right? So now we're going to talk about stuff that is usually, there is a rare exception in 401ks called NUA, or net unrealized appreciation. If you've had a 401k plan where you own company stock and you've owned it for a long time, it's worth reaching out to us. NUA, it's called net unrealized appreciation. But for most of you, the conversation we're getting ready to have is you have made an investment in a property, in a stock, in anything you can pretty much imagine other than a collectible. But you made an investment and it is going up in value. And we're going to give you some terms that you need to understand, because I watch people kind of throw them around without a lot of understanding of what's going on there. So first of all, what is a capital gain in itself? What does that mean, Aaron?
It means that you've earned dollars off your investment. So the way that I like to explain this to families in the office is I use Apple. Let's say you purchase...
We're a long Apple, we have to tell you that. That means we own it.
Sorry.
Right.
We have Apple stock. You want to invest in Apple because you think they're a good company, so you buy them at $10 a share. Today, it's worth $100. Using, again, fictitious numbers. So you've got that $90 difference there. That's where the capital gain comes in. It was the $10 cost versus the appreciation to $100, and so there's $90 there that is potentially taxable.
So he jumped ahead, totally right.
Sorry.
Right? But no, that's okay. It's okay. It's but I want to make sure, because I got in this conversation where somebody got I got confused. When we talk about the S&P 500, it is based on market capitalization. Cap's the short term, right? Market capitalization.
Yes.
And so somebody heard the term large term cap or long term capital gains and confused it with what the market and capitalization meant, right?
Yes.
And so it's very easy, because I live in this world. I mean, I can speak in synonyms all day long and really get people lost. So capital is money that you have, right, that you've typically already paid taxes on.
Yes.
Right? So I've gone to work. The employer's taken out my Social Security payment. They've taken out the withholdings that I have to pay on my 1040. And now of my $1,000 weekly check that I had, I've got $750 that I've already paid taxes on, right? Now, for some unknown reason, I don't need that $750 this week, right?
Yeah.
And I'm going to take that capital, right? I'm going to take that capital, that $750, and I'm going to go buy Apple. I'm going to go buy Apple stock, right? So as Aaron said today, that's about 5 shares, right? So I'm going to go buy 5 shares of Apple stock. So question number 1 is, what is my tax basis, Aaron, and where does it come from?
Your tax basis is your original cost to purchase that investment.
So does that include commissions and everything, or was it just the price the stock cost?
It's the price the stock cost, unless you tell me differently.
It is everything.
Yeah.
It's whatever the acquisition cost is. And important to that, it includes the sales price.
Right.
Right. So if you're working with a broker that actually charges a commission, and they still exist, you don't know that, because in the world that we live in, there's no commissionable charges. Our contract, because of the amount of money we manage at TD Ameritrade, there are no commissions that are paid in any way, shape, or form to TD Ameritrade or to us. We never get commissions. right? But they're not paid unless it's a specialized mutual fund that we're transferring in from another company, and that's
So just to break this out in an example, so that $750 you invest in Apple, let's say there is a $50 commission, which would be potentially high today. That total cost was $800, so that's your basis.
that would be your basis.
Yeah.
Or if you only had 750,
And then you
right, 700 of it would be for the stock,
Correct.
but $50 of it was part of the
Commission.
acquisition cost that's there. And it's not, though different people argue different ways. You clearly should not do this, in my opinion. I've seen some CPAs actually itemize some of those costs along the way and take them to lower the basis. That's another story. We'll leave that alone. But it clearly is part of that original acquisition. So when we talk about your basis, it's how much money. And so again, we're not talking about an IRA or 401k. It's how much did you put in the original investment. Now that original investment grew up.
Okay.
Right? And it went from the $750 on paper to $5,000 on paper.
Wow.
Right? And I ask you if that's a long-term or capital gain or a short-term capital gain, and you ask me what?
How long have you owned it?
How long have I owned it? Now, let's just break this down. So a short-term capital gain, I have owned it for how long?
Less than 12 months.
Less than 12 months. And a long-term capital gain?
More than 12 months. 12 months and a day.
So what's the difference between the two as far as the IRS is concerned?
The way they're taxed.
Okay,
So
tell me.
long-term capital gains are taxed at preferential rates or long-term capital gain rates, which could be 0, 15, 20, depending on income. And then short-term capital gains are taxed at ordinary income. And from our show earlier, that would be where you fall in your marginal bracket.
So if you were in the 22% bracket and you had a short-term capital gain, you're going to pay capital gains rate that at that 22% bracket,
Yes.
right? So what does that formula look like? I put in 750, I got 5,000 out. How much would I pay taxes on for short-term capital gains?
It would be the 5,000 minus your 750, so 4,250 times 22%, roughly $1,000.
You didn't even have to go that far, but what I want you to take away, and we do have a group of middle schoolers listening to us this week, that are trying to understand this stuff, and
cool.
I'm so proud of you for trying to get it, and it's important stuff, right? So you've got a short-term capital gain, you owned it less than a year. You've got the money you originally contributed that you already paid taxes on. So it's not your tax base, it's basis. Not to get confused if they're trying to trick you up on a vocab test, right? It's your tax basis. It's what you've already paid taxes in on that item, right? Then you take off the appreciation when you sell it, and you have to pay the taxes on that. When he uses the word, he being Aaron, uses the word preferential, that means it's a good thing. Right?
Yes.
There are dividends that are taxed preferentially. It means the bracket isn't as high as your marginal bracket. And there's capital gains that are taxed preferentially. Short-term capital gains, not so much. So if you've owned it less than a year, and then you're not going to get any preferential treatment. You're going to pay it at the marginal rate. In fact, you're actually penalized.
Yeah.
And so much that you can't even make charitable gifts and get the deduction the same way if it is a short-term appreciation.
Yes.
There are a lot of reasons why the government doesn't want to reward you for short-term transactions. We watched it, the year of 2021, GameStop was obviously one of the big ones. And I watched somebody come on CNBC, and it's funny. I've been on CNBC a bunch, and you had the guy in the middle who was doing the questioning. And you had the one guy on one side who didn't know what the heck he was talking about. And you had the other guy on the other side who knew exactly what the other guy didn't know what he was talking about.
Oh,
right?
gosh.
Now follow along. So, right, because the one guy had owned the GameStop for a month and made this charitable gift of several $1 million of appreciation. He said, I don't want to make any money off this. I'm going to get a charitable deduction. And it's all going to be good. And and gave away the $4 or $5 million. And the guy in the middle's going, that's great, but you don't have to pay taxes on it, and all of this other stuff. And the guy on the other side's going, uh-oh, Lucy, we Houston, we have a problem here.
You have a big problem.
You're right. You're not going to have to pay taxes on it, but your charitable gift is the mere $100,000 that you put in, not the $5 million that it had grown to.
On top of only being able to write off 30% of your AGI.
Well, in this case, that didn't matter because he only gets to write off the $100,000.
Okay, yeah.
And he's probably $1 billion a year guy. It was one of the hedge fund managers. So it's not going to hurt him, but it's just it's that, you can be really, really smart in one area and miss part of it. And I will always take people back with taxes and investing and the complication. I go to James Clear every time, author of Atomic Habits. One of my favorite quotations so far between 2020 and 2021 is success is never dependent upon one thing, but failure can be. Mm-hmm. Right? And when I look at our family focus process that starts with your financial vision, and then we go through the 5 critical elements: your life after work, your annual tax plan, not annual tax report, annual tax plan, the investment playbook that needs to be dealt with all the time. Life happens. It's the surprises, the good, bad, and ugly of life. And then last but not least, the legacy plan. It doesn't matter how much you get one of those right. If you get one of them really wrong, everything else can be for naught. Right? If you've put all of your money inside of an IRA and inside of a 401k, and all of a sudden, for some reason, the house burns down and it's not covered, or the car blows up and it's not covered, and now you have to take all of the money out of the IRA or the 401k and pay the taxes and the penalties and everything else so that you can fix your house or fix your car, all of the other suffering and agony you went through was wrong.
Yes.
Right? If you don't have all of these working together, you're in trouble. So think about it from your health. I mean, I'm a health nut, right? The bottom line is I've done this for 33 years. People will give away their health to get wealth, and then they will give away all the wealth to get the health back, right? So it is sleep, it's nutrition, it's proper hydration, it's movement, right, in terms of being able to get there. And then some of us believe in the spiritual and the meditation part to take care of your mind. And Aaron and I do. Mm-hmm. But regardless, if you miss one of those, it doesn't matter how much I work out. If I eat pizza and ice cream at every meal, it's not going to work, right? Me just working out is not going to cut it. It's a system. And that's what Aaron and I were trying to get to you on this thing. It is a combination of all of this stuff working together. You may want to give stock or give money to your church or charity. Aaron and I are going to encourage it. It's personal missions of ours to help people do that. But you need to understand the rules.
Yes.
Right? And you can't take a little blog post or a snippet off of CNBC and assume that the people that are on there know what they're talking about. They may know a lot about some subjects.
Yep.
But there's a reason we collaborate with outside estate planning attorneys and CPAs at the Financial Enhancement Group. We have a great group of people that work together, and we'd like to work with you as well. If you're looking for a fiduciary, give us a call at 800-928-4001, yourlifeafterwork.com.